of course, has done bulk of the heavy lifting today. The Nifty IT index itself is up 1.5%. And, names like Wipro, HCL Tech are also inching up. In fact, there's a very interesting note which has come out, which is written by Jefferies on the IT sector, where they talk about Indian IT's outperformance. Now, Indian IT has been outperforming for the last 1.5 years now. The outperformance began in 2023, where the Nifty IT outperformed the Nifty by about 4 percentage points. The Nifty IT went up 24%, while the Nifty was up 20%. And that has continued in 2024 so far, with the Nifty IT index up 17%, while the Nifty is up 15%. So it's been about 18 months of outperformance, and this outperformance is despite earnings cut. So Jefferies has done analysis. If you look at the calendar year 2026 EPS estimates, except for TCS, for all the others, it's come down. And for some of them, it's as high, particularly on the mid-cap end, it's as high as 12 or 13% for Tech Mahindra, Coforge, LTI Mindtree. We're talking about EPS cuts of about 10 to 15%. So this up move that started, in 2023 for the IT names and accelerated and gathered steam in the last 3 months is largely led by PE re-rating. It's not led by earnings upgrades on hopes of a sharp growth recovery. So they say that the Nifty IT 16% year-to-date rally is driven by an 11% increase in the forward PE multiple. Also, there are now divergent trends between Indian IT companies and Accenture. So Indian IT is trading at a premium to its historical average, last 5-year average, which takes into account the COVID years and the bumper COVID years. But Accenture is now trading at a discount to Indian IT companies. So according to Jefferies, valuations today are rich. The Nifty IT is trading at 29 times multiple. It's a 40% premium to Nifty versus an average premium of 23%, making the valuations rich. And therefore, Jefferies would choose to be selective on the sector, and they would prefer Infosys and TCS because there are limited risks to earnings growth and there is relative valuation comfort. So this outperformance is driven purely on PE re-rating, and this is despite there having been earnings cuts.
Okay, well, moving on,